Dear students, welcome to this lecture video on Module 6, Asset Recognition and Operating Assets. The first problem we would like to tackle is this one: adjusting balance sheet and income statement for LIFO to FIFO. So we have this information for a company, and we have to adjust the account balance for the following financial statement items, assuming the company used FIFO instead of LIFO. So the company, this information is under LIFO. We have to convert for FIFO. So what is LIFO? LIFO is last in, first out. And FIFO is first in, first out, right? So under LIFO, as the name suggests, last in, first out, what happens is the company using LIFO, they move the most recently acquired inventories to the cost of goods sold first, right? So generally we assume inflation is positive, so the prices are increasing. So when a company uses LIFO, what they're doing actually, they're moving the more expensive items first to the cost of goods sold. So as a result of that, the remaining inventory is which is remaining on the balance sheet is actually has a lower value than the market price. So the inventory balance is underreported under LIFO, and that underreported amount is called LIFO reserve. So that is why if we want to convert it to FIFO method, so FIFO is first in, first out. So we have this formula: FIFO inventory is equal to LIFO inventory plus LIFO reserve, right? So we can answer part A then. Inventories should be our LIFO inventories plus our LIFO reserve. So which should be equal to $7,361. So we are going to paste this number here. Now, total assets. So inventories are part of total assets, right? So in total assets will also increase by the same amount. So 7,361. So our current total assets is this. Plus increase in inventory. So 43,547. Okay. Now cost of goods sold. So in case of cost of goods sold, what happens? Your cost of goods sold under LIFO is overestimated, right? Because you are moving the more expensive inventory to the cost of goods sold. So cost of goods sold are higher than they should be under FIFO. So for cost of goods sold, what you have to do is so to find out cost of goods sold under FIFO, you have to take LIFO cost of goods sold, and you have to subtract the increase in LIFO reserve if it is an increase. Or if it is a decrease, you have to add the decrease in LIFO reserve. So here we have to focus on the increase, right? Or decrease. That means change in LIFO reserve instead of the total LIFO reserve. Because in case of balance sheet, we need cumulative effect. So we need the total reserve. But in case of income statement, we are focusing on the changes in cost of goods sold, right? So our C, cost of goods sold, should be our LIFO cost of goods sold, which is this amount. And then let's see what happened in case of LIFO reserve. We had a decrease in LIFO reserve, right? So we have to add 179. So that is our cost of goods sold. Now for net income, so our cost of goods sold was underreported, right? So cost of goods sold, that actually under LIFO, what happened? Under LIFO, what happened? Cost of goods sold decreased, right? Decrease in cost of goods sold. That is why we had to increase by this amount. So decrease in cost of goods sold was 179. So that basically means our expenses decreased. So our pre-tax income actually increased, right? Expenses decrease, meaning pre-tax income increase. Increase in pre-tax income is also 179 under LIFO. So because pre-tax income increased, our taxes also increased. increase in taxes, which will be this amount, the pre-tax income, times our tax rate, which is 22%. So 22%, 179.22. So 39.38, right? So that is the increase in taxes. As a result of that, our pre-tax income increased, taxes increased, so increase in net income will be the difference between these two, right? 179 minus this, so which is 139.62. So that is increase in net income under LIFO. So to convert to FIFO, we have to decrease in net income by the same amount. So our net income will be this current amount minus the required decrease. So let's see how much we get. 4,756 minus 139.62. So $4,616.38. So round to the nearest dollar. So that was the end of question 1. Okay. Now let's move to our next problem. Okay, let us work on this one, question 3. So question 3. So what they're saying is adjusting balance sheet and income statement for asset disposal. USP Delivery recorded a loss of 1,617,000 loss on the disposal of fleet activities, fleet vehicles. We wish to adjust the company's income statement and balance sheet under the assumption that the vehicles in the fleet had been used for the prior 5 years. See analyst adjustment 6.2 guidance. The company's tax rate is 25%. For the income statement, identify with numbers the adjustments for the current year and the prior 4 years. Okay, analyst adjustment. So what that basically means, if you go to 6.2, so this is the adjustment they're talking about. So in this case, it is an example of gain. Our problem we are going to work on is about loss. So the idea is this analyst adjustment. So this is the loss, right? So a loss happens when the book value is greater than the market value of the asset. Market value meaning selling price. So the company doesn't need this vehicle anymore. It doesn't serve the purpose. Probably they need a new one. So they want to sell it. but they incurred a loss because they couldn't sell at the same amount that is reported under book value. They had they sold the vehicle at a lower amount, resulting in a loss relative to the book value, right? So what that basically means then, before I go there, so this is a asset disposal example, but remember, as a financial analyst, you want to find out the cash flows or earnings which will be recurring, part of core operations. So this is not an example of regular activity, right? So that is why you want to represent this amount in a way that doesn't affect the current year income or loss inappropriately. So because if you record this loss entire 1.617 million only on the current year, you will see a significant drop in the current year net income, right? But the arguments to change this accounting treatment is that so the loss happened because book value is greater than market value, but book value is greater than market value because the depreciation was lower than required, right? Depreciation is lower, and as a result of the book value was higher, and market value was higher than lower than the book value. So depreciation was higher than it's supposed to be. So as a result of that, what we have to do, we have to actually revise our estimation of depreciation, and we have to spread this loss amount over the prior 4 years and the current year. So this is about this problem. So let's focus on this first part. For the income statement, identify with numbers the adjustments for the current year and the prior 4 years. So first of all, it was a loss, so the current net income reflects this loss. So, and we have to reverse this amount. So because it was a loss, it was deducted, we are going to add this. So we are going to add this amount. Okay, 1.617 million. Now, because we are going to add this amount, that means it's a gain now, we have to also increase the taxes. So the taxes, part A, so taxes will be our gain times the tax rate, which is 25%. So this times 0.25. Okay. Now this one I'll include here. So now I reversed the loss into a gain. Because it is a gain, I have to pay taxes, so that's why I have to also increase the amount of taxes. So this is a positive, this is a positive. Now the net income will be then, this is my gain amount, but tax also increased, so the difference between these two. So net income will be is minus this, right? So that will be my net income. Okay. Now, this is for the current year. We just reversed the current year numbers, but we have to now spread out our gain, our loss, right? In this case, we just reversed the income statement of the current year. Now we will go into the previous year, how to allocate more appropriately, more proportionately. So first of all, remember our discussion that we had a loss by selling this vehicle because book value was greater than the market value. Market value is a selling price. So book value was higher because depreciation was lower, right? What is your book value? Book value is equal to historical cost minus the accumulated depreciation, right? So book value was higher. That means depreciation was lower. So we have to add depreciation. So under adjust, our depreciation will be, and we wish to adjust the company's income statement and the balance sheet under the assumption that the vehicle in the fleet had been used for the prior 5 years. So instead of reflecting the entire loss in this year, we want to reflect this over 5 years, including the current year. So that basically means our loss, this depreciation amount will be our loss divided by 5 years. So because depreciation was underestimated, we want to depreciate appropriately so that that loss actually is absorbed by our depreciation expense, right? So our depreciation was lower than it should have been. So we have to add the depreciation. So that is why it is a positive. So this will happen in each year. Okay. Now, because we are increasing depreciation, so our expenses are increasing. When expenses increase, your pre-tax income decrease. If your pre-tax income decrease, let me write down, decrease in pre-tax income, that means decrease in tax expense, right? So that will be our this amount times our tax rate, which is 25%. Decrease, so it will be a minus sign here. Okay, so we are going to apply, the copy pasting is working. Okay. Now our net income adjust. So net income adjust will be our increase in depreciation, right? This is our increase in depreciation. And then our tax expense, which will be $142,550, right? So now remember, we have an increase in depreciation, right? Which is an expense. And that will be offset. That means decreased by the increase in tax expense. So actually our net income will decrease by this amount. So now our total income total net income adjust, reverse plus adjust, this will be the same amount actually. So we don't have any changes here because we don't have any adjustment here. So this is reverse plus adjustment, but we have reverse amount only in the current year. So this amount minus our net income adjusted amount. So 1,212,750 minus this amount. Okay. Okay, so that was our part A, income statement, right? Now, okay, so now for part B, so that was our part A. For part B, we have to, for the balance sheet, identify with numbers the adjustments on the current year and the prior 4 years. Okay, so in case of balance sheet, what happens? We decrease the value of an asset by the accumulated depreciation, right? So in the first year, our accumulated depreciation was increased by this amount. In the first year, meaning 4 years prior. Now, 3 years prior, so 3 years prior, it will be another 323,400, right? The depreciation. So basically what that means, this times 2. And then 2 years prior, it will be this amount times 3. And then prior year, it will be multiplied by 4. Prior year means we have to adjust depreciation expense by this amount for 4 years. That's why multiply by 4. 2 years prior by 3. 3 years prior by 2. So let's do this. Times 2. Times 3. Times 4. Okay. For current year, we do not need any adjustment because of all the prior adjustments, the balance sheet will be correctly restated already. Now, similarly, following the same logic, our tax expense, right, which were underreported, now they have become liabilities in the balance sheet. So deferred tax liabilities. So they will increase by this amount. Similarly, this and then multiply by 2. And then and no adjustment necessary here. I can enter 0, 0. And remember, these are our tax liabilities. So again, I strongly recommend you to go over these problem also, because this is on a gain and our problem is about a loss, right? So now this will be our tax expenses. Will minus this, right? So our depreciation expense needs to increase by, and our tax expenses need to decrease by each year by these amounts, right? So what that basically means, our tax liability. So I misspoke because we are increasing depreciation and decreasing tax expenses. So that basically means our we paid more taxes than we should have paid, right? Depreciation expense increase, pre-tax income decrease, that should reduce tax expenses. That's why you have a minus. So these are actually not liabilities. These are our assets. So our deferred tax should be decreased by this amount. So now our retained earnings will be so our accumulated depreciation needs to increase, and then our tax expenses so this is our accumulated depreciation, and this is our deferred tax. So the difference is $242,500. Now remember, we are increasing depreciation expense. So that basically means our net income needs to decrease, right? So that's why we have a negative sign here. Okay, I still have the problem with the negative sign. So okay, so this is for our prior 4 years. Now, this number, so retained earnings, this is 4 years prior, and then 3 years prior will be our accumulated depreciation, and then minus our deferred tax. So 646,800 minus, so 485,100. Okay, so this is a negative sign, not a bullet point. I wanted to fix it, but I could not. Okay, so now similarly, our 2 years prior, it will be 970,000 minus 242,500. and then prior year. Again, in the final year, we don't need any adjustment. Okay, finally, I think we are done with this problem. So I just wanted to point out one thing here. So if you enter a positive sign, the homework, positive sign here, I mean, the homework might mark you wrong. If it does, I'm not sure they're going to. I think there is a mistake in this homework. In that case, just to get your points, use a negative sign for this loss. Okay. Everything else you can just follow as I wrote down here. Okay, so the next question is question 4. It is about intangible assets in an acquisition. So what type of intangibles did CVS acquire? So actually, to answer this question, I want you guys to go to the textbook and so go to so read this section, types and valuation of intangible assets. So there are different categories of intangible assets. So if you know these categories, you will be able to answer a similar question like this. So customer relationships is a type of intangibles. Technology is a type of intangible. Okay, so I'll move to the next one. Estimate amortization expense on the newly acquired intangibles for the current fiscal year. CVS Health's fiscal year end is December 31st, and the company's policy is to depreciate and amortize assets beginning in the month that they were acquired. Okay, so question 4. So we have to find out amortization expense. So for customer relationships, so it will be, so this table tells us, following table summarizes the preliminary fair values and weighted average useful lives. Fair values, weighted average useful lives for intangible assets acquired in the Signify Health acquisition. So weighted average useful life. So that means each of these intangible assets have these weighted average lives. We have to find out what was the intangible expense for this year. And the company's policy is to depreciate and amortize assets beginning in the month that they were acquired. And they were acquired on March 29. So we have to acquire for all the months in that year from March. So that means including March, you exclude January, February, there are 10 months, right? So 10 months out of 12 months times how many years? 16.7 years. So this is the time, right, for which you have to calculate customer relationships. and multiplied by the total fair value. So this will be this times 10 divided by 12 divided by so round answers, it should be 181. So you can follow the same process for all the others and then total them. Okay, that was easy. Now question 5. So for question 5, we have this information. So property, plant, and equipment net, right of use assets, sales. So we have to calculate property, plant, and equipment, PP&E turnover ratio. So PP&E turnover ratio is your sales divided by average PPE net. Okay, so in fiscal year 3, our sales amount is this, and then our denominator is average property, plant, and equipment net. So fiscal year 3, this should be our that should be our denominator, and our ratio would be so 3.51 up to 2 decimal place. So if you follow the same process, you will get to the correct results for fiscal year 2. Now for part B, so that was part A. For part B, what we have to do, we have to adjust property, plant, and equipment to include ROU. So ROU is right of use assets. So what that basically means, so these are operating leases. So sometimes companies do not buy expensive equipments the lease. Now, if the lease, they may not include this within the property, plant, and equipment directly. So, but if the lease is longer than 1 year, it should be treated as something that they actually own. So that should fall within property, plant, and equipment. So that is why when we calculate this property, plant, and equipment turnover ratio, we should include the right of use assets. So there is a nice discussion in the textbook about this. If you go to yes, so right of use assets. So there is a nice discussion here. I strongly recommend you to review this, the logic. So what we have to do basically, just add these to the property, plant, and equipment net to find out the revised value for property, plant, and equipment net for the numerator of our ratio. So our numerator will be then fiscal year 3 will be first this amount, add right of use assets. So I made a mistake here, right? So this is just the property, plant, and equipment for fiscal year 3, not the numerator. So net including ROU. So this is this amount. Now we'll also need fiscal year 2 PPE net including ROU. So this will be plus this. Okay. Now we can find out fiscal year 3 denominator. It should be, it will be the average of these two numbers. So this is our denominator. Our numerator is sales, right? So that doesn't change. And then you can find out the results. here. $1.43. So again, this is the average of these two numbers. So if you follow the same process, you'll be able to calculate the same numbers for fiscal year 2. And I'll let you think about this part C. That was it for this lecture video. I hope this is helpful. You have a great day.